dollar today is worth roughly 1 cent versus the dollar of 1870, 2 cents versus the dollar of 1919, and the lion's share of the dollar decline has taken place since the 1970s when we unhinged the relationship between gold and the dollar. The long-term dollar decline began with the birth of the U.S. Fed in 1913, and as we looked at that chart, that ended over 100 years of dollar price stability. The U.S. is now running total annual budget and trade deficits exceeding 1.6 trillion, larger than we have stated here. And the Fed is creating annually between $1 to $2 trillion in new dollar liquidity on an annual basis. That kind of liquidity has a phenomenal effect on things like the Dow Jones Industrial Average, the Dow Jones Transportation Average, the Dow Jones Utility Average. They've all been moving nicely since 2001, 2002. If, however, you divide, like we looked at the chart earlier, divide their price performance by the price of gold, real money, in our opinion, you actually have declining trends in all three averages. So U.S. debt has grown roughly 5.5 times since 1980, from $8 trillion to $44 trillion, the biggest debt explosion in history. How do governments typically deal with debt? Several alternatives. One is to raise taxes. We're all familiar with that. We've seen lots of it in our lifetime, and I would be prepared to see a lot more of it in years to come. They can print money, as in Weimar Germany. Prior to World War II, they can sell off or privatize national assets, such as telecommunications, water systems, rail, transport systems, or real estate. They can repudiate debt, as Russia did in 1917, or they can simply resort to plunder by launching wars to acquire wealth and pay off their debts, i.e. the Roman Empire, the Spanish Empire, the Nazis, or even the Japanese in the 1940s. The effect that this has had on the U.S. dollar in the last 6 years or so looks something like this. 32% decline, and it doesn't take a genius to look at this kind of a chart and say this is not a good thing to be investing in. In fact, that is why large dollar holders are beginning to exit the dollar. The U.S. dollar became the world's reserve currency in 1944. The Bretton Woods Agreement established us as the world's sort of monetary authority. Everything had to flow through dollars or be related to dollars. Most international transactions were denominated for the next 62 years, giving us an unbelievable financial leverage and power both in the world economy and also politically. That's where we've had the greatest degree of leverage. Large foreign dollar holders who've seen that 32% decline in the dollar and in the value of their holdings are beginning to exit and diversify out of the dollar. The United Arab Emirates announced that it would cut its dollar holdings in half in October of 2006. Also in October of 2006, Japanese life insurers with roughly $1.6 trillion in managed assets announced that they would begin diversifying out of their dollar holdings. Central banks in Asia, from China, Japan, Taiwan, South Korea, and Hong Kong have also begun to diversify out of dollars. China, significantly, with its $1 trillion, 1.07 trillion in foreign currency reserves, has roughly 700 billion of that in U.S. dollars. They're beginning to cut back on their purchases of U.S. treasuries. Russia has cut its dollar holdings last year from 70% to 40%. Italy recently cut its dollar reserves by 21%. Sweden has lowered its dollar reserves from 37 to 20 over the past year. Chinese central bankers are pushing for countries worldwide to rely less on the dollar for world trade. Foreign central banks holding roughly $2.94 trillion, if they were to diversify even 10% of their assets, you'd see $294 billion dumped onto the market. A 20% diversification, $588 billion dumped onto the market. Has a very negative impact on the price of the dollar, and of course, interest rates are on the rise in that scenario. Foreign commercial institutions, banks, insurance companies, and pension funds have between $7 and $8 trillion in U.S. dollar-denominated assets. And clearly a 10% diversification, $700 to $800 billion would be negative. What does something like that look like? To bring it home, the subprime market is wonderful to illustrate. Insurance companies are not allowed by mandate to have paper in their portfolios that is below investment grade. Most of your subprime paper is at one notch above. Not necessarily junk status, but it wouldn't be investment grade if it was dropped just one notch. So the entire ability, the subprime market and their ability to finance their operations is dependent on S&P, Moody's, and Fitch to say whether or not their paper is still in that investment category. The day that they're downgraded is the day that you have billions of dollars worth of paper dumped onto that market. That creates something of, call it a maelstromic vortex. It's not pretty, and it tends to snowball out of control. So we see huge foreign selling of U.S. dollars, and this is very critical. That is the key component driving interest rates and inflation through the roof. As foreign diversification from the dollar accelerates, they will slow or stop their purchases of U.S. Treasuries floated to finance the 1.5 to 1.6 trillion annual trade and budget deficits. And the question is, who will buy these Treasuries? Markets don't always drop because of outright liquidations. If no one shows up, the price of any asset is automatically, the bid of any asset is dropped to a level at which someone will purchase it. And that has the natural effect of raising interest rates. The world is moving from U.S. dollars as the world's reserve currency to the euro. Global central banks hold 65.4% in U.S. dollars, down from 71% in 2001. 25% of global reserves are in euros, 10% in other currencies. OPEC oil producers, Russia and China, are pushing to redenominate global oil transactions in euros. Iran, Venezuela, Russia, Nigeria, Angola, and others have already begun to denominate their oil transactions in euros. Announced this morning, Iran is now at 60% of all of their oil traded is now in other currencies other than the dollar. They're making headway with that even as we speak. In mid-2006, the IMF director for the Middle East and Central Asia urged the Persian Gulf countries to peg their currencies to the euro instead of to the dollar. And this is perhaps one of the most important things that's happened in the last 12 months. There is now more euros in circulation worldwide, i.e. currency and bonds, than dollars. So the euro is now big enough to become the new world reserve currency. There's been a practical dilemma. Since 1944, there may have been other countries that enviously wanted the position of world reserve currency, but they didn't have liquidity. There was not enough out there to substitute and to be in every central bank around the world. That is now changed. The euro has that kind of liquidity. Foreign dollar holders are diversifying their dollar holdings into euros, British pounds, Swiss francs, and other strong currencies, and also into commodities, including gold and oil. We saw the Chinese do this in earnest within the last year or two, growing their strategic mineral and oil reserves. As we've seen that decline in the dollar from 2001 to the present, the inverse corollary, the inverse correlation we've seen show up in the price of gold, a mirror image. They tend to move in the direct opposite direction. So whether it's inflation or just simply dollar decline, that relationship is important to keep in mind. Gold and the collapsing U.S. dollar. Over the past 36 years, while the U.S. dollar has declined 80%, gold has risen nearly 1,900%. Today, it takes 5 times more dollars to buy the same amount of goods and services that the dollar would buy in 1971. Since 2001, the dollar has dropped nearly 32%. Gold is up nearly 173%, roughly 29% per year. It can be concluded that gold is a perfect hedge against a depreciating dollar. So we've looked at the weakness in the dollar. Next, we want to look at the Middle East and the conflict that's growing there. Actually, that's point number 3. China and India and the changes that are developing in China and India we'll look at first, and then the Middle East. The transition towards India arguably started taking place around 1901. When the Ottoman Empire and the Austro-Hungarian Empire came to an end in the late 1800s, that set the stage for transitioning from a Western mindset to an Eastern mindset. And today we're beginning to see that take traction as you have people in power who are willing to take practical steps towards opening their societies, if not politically and socially, certainly economically, opening towards capitalism. China and India have been at the forefront of that, and that's where we continue to see the greatest growth.